Francis Chong, Senior Strategist, Asia ex-Japan for Agricole, joins us on the show right now. Francis, thanks very much for speaking with us. A few days ago, India raised government bond investment limits for foreign investors by $5 billion. Will this trigger inflows, you think?
When investor confidence is high and when there is some sustained periods of risk-on trading sections, I think measures that ease restrictions for foreign investors to tap the local market could be very effective. However, under the current market conditions, when investor confidence is yet to come back, I doubt if all these measures by the Indian authorities could help a lot. And in addition, there is also a threat of credit downgrade on the Indian sovereign. So I think in the first place, when interest in Indian bonds is not high anyway, so these measures may not be able to having a huge impact in the near term.
We've seen virtually no money flow into infrastructure bonds either. Now that the government has reduced the lock-in period to 1 year from the earlier 3 years, do you see interest picking up?
Under the current market conditions, I think a 1 year lock-up period is still looks quite long because the market are really changing from day to day, and so one day you may not know tomorrow if it will be a risk-on or risk-off trading day. So I don't think that shortening of the lock-up period can help a lot at the moment.
The withholding tax has been one of the very contentious issues for FIs investing in the Indian bond markets. There's a likelihood that the government may also do away with this tax altogether. Do you expect that to revive interest?
Yeah, I think if you do away with the withholding tax, the impact could be relatively huge because it essentially means a jump in the effective return that foreign investors are getting. So given experience of other sovereigns as well, that I think removing the withholding tax is not facing a very high hurdle. So that if India really do that, I think it has a hope of reviving some foreign inflows into the Indian bond markets.
How are you viewing the currency right now in India, the rupee?
India, except Vietnam, is the only economy in the region that is having a current account deficit. And on top of that, it is also having deep fiscal deficits. So I think the rupee will still be relatively vulnerable in the near term, easily testing the 56 handle if market sentiments get negative again. Having said that, in terms of valuation, the rupee is relatively undervalued compared with its regional peer ever since the credit crisis in 2008. So if markets stabilize towards the end of the year, we are looking for the rupee to strengthen towards 52.
All right, some piece of news coming in on your screens there. We'll try and get you more details on that. The Aditya Birla Group to take over Canada's Terrace Bay Pulp. That's the only flash that we have as of now. What's the size of the business? Well, they're buying it for about $300 million. What will be the payment structure and, whether it will be an all cash or a share transaction? I don't think those details are out, but this is just the two pieces of information that we have as of now. The Aditya Birla Group to buy Terrace Bay Pulp for $300 million and, they are going to be looking at this acquisition very soon. I think the timeline will also come by in just a bit. One very quick word, Francis, in fact, the last one. Now, what is your overall view on the biggest concerns that FIIs have right now while taking the decision to invest in India?
I think there are two main concerns. First is the twin deficits that India is posting, the fiscal deficits and the current account deficits, which means that the Indian market is very vulnerable to any risk reversal, any capital outflows, etc. So when this outflow happens, then it means very negative for bond investors or foreign investors. And at the same time, if the rupee also depreciates, which usually happens during this risk-off trading, then they will lose both on the bond side and also on the currency side. And the second, of course, is the threat of credit downgrade. If you only look at the external positions, the threat about a downgrade is not unrealistic. What is keeping the current credit rating, I think, is perhaps the growth potential of India. But the RBI failed to cut interest rates to stimulate growth, which is sending a really negative signal to the market and also add to the actual possibility of a credit downgrade down the road.